Everyone, this is Mortgage Pros 411. I'm Audrey Boissonou with Kevin Casey, and today we are joined by Nadia Evangelou. Thank you so much for joining us, Evangelou. Nadia.
That's correct.
Hey, I
Hi,
get
how are
that all the
you?
time.
To come
People
up.
always call me Casey. I don't
Uh,
know why.
how are you?
I'm good, and thank you for having me here today.
Oh, we're thrilled to have you. Nadia is with the National Association of Realtors, and she is the senior economist and director of real estate research. So she's going to be very, very interesting to talk to today. Before we get into it, a few little housekeeping mentions. We are part of the Crispin Commentary and Marketplace group. And if you have not done your NMLS update for this year, your 8 hours, we are doing one live in Campbell this Thursday, and then another in Sausalito on Monday. And the one in Sausalito is at the Yacht Club, and it's the most glorious views of the bay in San Francisco. And so, for goodness sake, get your.
And then there's one more after that.
There are several more after that.
Well, next week we also have
Oh, right.
Westlake.
Where?
Westlake? Well,
Okay,
Ventura
down.
County.
And it is the Greater Ventura chapter of camp that's putting it on. So we'll make sure we mention that on Tuesday. There is something else going on with NMLS. I received something that said that I had to re-up my fingerprints and criminal background check, which I've done recently. So if you're in the state of California, my understanding is, and I have an email in to clarify this, that you are they're requiring that you have new criminal background check and fingerprints. So to find out for sure, log into your NMLS early, like now, and see if that's required, because then you could just get it knocked out.
I had a new one I learned yesterday about my NMLS because I got my Washington license. Unlike when I had a California and Oregon license, Oregon would take my 1 hour California course as credit towards the 8, but Washington does not. So I had to sit through a 1 hour general NMLS class this morning just for the fun of it. It's just joyous.
Okay, first of all, we all have great attitudes about our NMLS updates, Kevin,
Mm-hmm.
mostly the instructors. So I'm sure you are very excited to educate
Oh,
yourself.
I was thrilled. I was just so thrilled to get it up at, it's dark 30 this morning, get that knocked off.
They could be onto you. So it could just be you. Maybe not everyone has the same, requirement. Okay. With that going on, we are also looking at a another big week. So last week was jobs week. This week it is, well, we have a lot to talk about, but up tomorrow is PPI, personal producer price index. Good God, what's wrong with me? And mortgage apps. Thursday, we have CPI and jobless claims. And today, the 10-year is at, well, last time I looked, 4.08. And
That's phenomenal.
so it's hanging in there. The market is off this morning a little bit after that QCEW report. And so it'll be interesting to see where it lands by the end of the day. But just keep an eye on those rates because we do have a lot more news coming this week, and it really can and does move the markets.
I mean, that T-bill it used to be that 4.35 was a good lock number, and not anymore.
Well, so a few weeks ago, like Jackson Hole, we
Yeah.
were 0.3 something, and yes, and we were at 4.5 earlier in the year. So we are definitely headed in the right direction. It'll be interesting to see how it goes from here. So one more thing before we dive into jobs is the trigger lead bill finally passed. Finally, not just passed, sorry, the
Yes.
president signed it last Thursday. So it is now law. Now, when does it actually go into effect? Normally it would be 3 months, but as we know, industry, in other words, the three credit bureaus have asked for an additional 3 months because someone can't figure out how to push the button that will make it stop selling trigger leads. Apparently, they need more time. So my contention,
It's so complicated.
yeah, they're looking for more ways to get money out of us. I'm convinced of it. That they're like, listen, we need a little more time to figure out how to get our revenue to not take a dive after we stop selling your personal information without your permission. The other thing that will be interesting to see is how people figure out the workaround. Our understanding is that
They're
you
already working on it.
what?
They're already working on it. probably buying TikTok leads.
They are definitely working on it, but I mean, my understanding is you lose your license and you can, I think it's a felony. I mean, it's like a big, huge penalty if you are involved in this kind of behavior. Yet I hear these people talking about how they're going to work around it. So, there's always some slime ball out there who's trying to.
Well, speaking of slime balls, I think there's one at Philadelphia fan that was down in Miami over the weekend that stole the baseball from the kid there. I think there might have been an LO who's upset that you can't use trigger leads anymore. But that's my rumor I'm
I
spreading.
know. So Kevin sends me these videos this weekend. He's like, first you have to watch this, then you read that, then you have to see that. And it was like all these different instructions. But the bottom line was some crazy Philadelphia fan thought that the ball should have been hers and literally took it from a child. I mean, it was so ridiculous. Did you see that, Nadia?
No, unfortunately.
Oh, you got to watch it. It's classic.
Kevin was a little excited about that. So anyway, there you go.
And
So
just to be clear, as I understand, all Philadelphia fans are crazy.
well, okay, so let's be careful here because we may have
Mayhaps.
I think we might have a couple on the show,
but
but they would usually admit it.
okay, that's the whole thing. So in one of the videos that Kevin made me watch, there was the dad of the kid who had the ball, and he's the one. They're from that area, and they said that, Philadelphia fans are a little, let's go with wild. How about that? Okay. So, someone is asking why we need new fingerprints. Do our fingerprints change? That, my dear, was also my question. I think my fingerprints have remained the same, but they want to do a background check and they're still trying to make sure that they're connecting, like the person who, it's those fingertips that are connected to that background check. Let's just give them.
Yeah, it's your fingerprints are connected to your background check, not your name, because people can tweak their names, but they can't tweak their fingerprints.
Yeah.
Yeah,
Um,
you could easily have someone come in and file under your name, and kind of
well,
like some people try to do that with their NMLS test and have someone else pretend they're them. But if you
yeah.
had to put a fingerprint, then they would know it wasn't you.
As we heard from the DRE a few years ago, people are also stealing our NMLS numbers and our pictures and closing loans under our names and our license numbers. So we got that to work with. Okay. So Ed pointed out that they're still going to sell trigger leads. And yes, there was a carve out for servicers and if you have a relationship with someone, but it definitely is going to become less easy. And hopefully the 2000, and that was what happened to a congressperson, 2000 calls, texts, and emails and solicitations will end. We'll see. What do you think, Nadia? Do you have any opinion about any of this?
No, unfortunately.
You have to
Yeah.
deal with that.
They're not studying that at NAR. Okay. All right. So let's see. And
I'm surprised NAR doesn't track the number of phone calls borrowers are getting from all these loan officers when credit pulls are made. I mean, that's something you guys could be tracking.
well, they don't. They're looking at what realtors are doing. They're in NAR. Ours for realtors, not for mortgage. So that's their focus.
We try to capture all the market. Yeah. So all the components of the market.
Okay. So we've got comments coming in about Phillies fans. Someone said that Philly fans have been known to boo Santa Claus.
Yeah, I went to a Phillies game in Philadelphia with my cheering for my San Francisco Giants, and they were very nice to me. So
Oh, they were?
yeah.
Oh, well, I was gonna compare them to a football team until you just said that, but
Yeah, no, I wouldn't go cheering my football team in Philadelphia. That would be a bad idea.
well, and also, well, anyway, okay, we digress big time, which is fun, by the way. Yeah, and so Ed is asking, what are the credit bureaus going to do with a huge chunk of income gone? And my point is that's why they needed the extra 3 months. So in 6 months, we'll find out because they're going to figure out something. So anyway, okay, let's talk about the fact that we had jobs week last week, right? So we had BLS, we had ADP, we had jobs, and everything came in lower than it was expected to come in. So, beating all that to death at this point really makes no sense since today we had QCEW, and really we're going to talk about that. But just to give you a quickie overview, we had the business survey that was up 22,000 jobs on BLS versus the 75,000 that were expected. But the more important numbers were the revisions for June and July. which were down negative 21,000 jobs. And so June was originally reported to be up 147,000 jobs and is now with a final revision at negative 13,000 jobs.
That is a significant miss.
Yeah. Well, that's nothing until you get, let's just wait, baby. It's coming. So this is a business survey. And so then we had, anyway, bottom line is jobs were crap. Unemployment rate is now at 4.3%. And in the U6 jobless rate is at 8.1%, which may be the more accurate, characterization of jobs. Okay, so QCEW, which I always have to like remind myself what it means. Quarterly Census of Employment and Wages Report. So this is the 12 months leading up to March of 2025, right?
Yeah, it's April 2024 to March 2025.
So we thought 818,000 jobs revision last year was bad. This year, 911,000 jobs. That means that on average, the jobs were overstated by 76,000 jobs. They don't break it down by month, but anyway, so overall.
And they just said that they job loss of -13, so you can add another 70,000 to that.
And 52% of the jobs that reported every month were not ever created. So, and this is in addition, Nadia, clarify this for me. This is in addition to the revisions that were done initially, right? Like over time, this is the revisions plus 911,000 jobs.
So I can explain a little bit about this release. So this report, I will say, is a giant reality check. Like every month we get, as you mentioned, like the jobs report, but that's based on surveys and estimates. So once a year, what we do is that the government takes a more complete like, data set, basically payroll tax records from nearly every employer like in the country, and uses it to see how close those estimates like were. So today's release showed the economy actually like added about 900,000, like 911,000, like fewer jobs over the past like year from what we thought. And of course, that's a huge like adjustment. But what I would like to mention is that revisions happen like all the time. So they are totally like normal. It's totally normal to have revisions, but usually they are smaller. So 10 of thousands, not close to 1 million. So that's the that's why there's like out there like about so many comments about the release. So we originally like thought the economy added about 1.8 like million jobs from April 2024 to March of 2025, and it turns out that it was less than half that, like about 850,000 jobs. So that's an average, as you mentioned, like of only 75, I will say, like I round it usually just to remember 75,000 jobs like a month, which is like much slower pace than we believed. And one question I think that many people have is that why did we get it so wrong the first time? So why we had to revise it like so sharply? So I will say that it comes down to how the monthly jobs numbers are built. So they rely on surveys, as I mentioned, and a model that tries to guess how many new businesses are opening and closing. So in times of changes or uncertainty, like those models tend to overshoot sometimes. So and add to that those things like other like things like tariffs, businesses like leaning more to automation, and the job market just didn't grow as fast as expected. And the QCEW like cuts through all that because it's based on actual payroll like records. Should we be worried? Or otherwise, like what does this mean like for the economy? I will say, I will not like say that that panic is the answer. So, but it does change the story. So the labor market is still growing, just at a much slower like clip. So slower job growth means households may not have as much like income growth to spend, and that can ripple like into the broader economy. So it also means that the Federal Reserve has more reason now to think about like cutting interest rates since a cooler like job market takes pressure off inflation. So I think this is like what we need to have, like the takeaway from this release, and some of the things we need to have about this specific report. And also, when we look at for going forward, we need to have in mind that the final revision comes in February, but more importantly, we should keep an eye on the next few monthly jobs reports. So if they keep showing softness, that's when we should worry more about a real slowdown. If they stabilize, then this might just be a correction that brings us back to a more sustainable pace. So I will say the big picture is that the labor market is still adding jobs, but not nearly as many as we thought. So it's a reminder to take monthly numbers with a grain, I will say, of salt, and to use the bigger, more reliable data sets when we get them. Also, another data point that I think we need to emphasize is that from the monthly data that we get is from the jobs report, it was the first time we see it now for long that the labor market is tight. And what do I mean by that? That we have more unemployed out there than the job openings. So this shows when you have more unemployed looking for a job than the actual jobs, available jobs out there, and this ratio goes below the 1, that means that yes, the labor market is tight. Then unemployment rate, because I know that it's growing, as you mentioned, 4.3%. It's higher than with what we had in the recent months, but still it's a full employment. If you think about it, we have below the 5%. So yes, we see more unemployed there, but I think it's mostly where should be more focused is the labor market. It's getting tighter. We see more unemployed than the job openings, and this is a sign of a slowdown, I will say.
Right. So we saw the total labor force was up 400 on the U6, 436 in the household survey, 436,000 jobs, but the full-time jobs went down 357,000 jobs. Part-time jobs went up 597,000 jobs. And the number of people that are working part-time jobs because they can't find a full-time job, we're at 1.31 million people doing that. So people are really scraping, and I feel like we've had a lot of signs that there was weakness in the labor market way before now. And I think that last year's QCEW revisions of 818,000 jobs were a blaring signal. And again, we really try to straddle the middle, and so this is not on any level political, because I've been griping about BLS, I'm not joking, since 20 years ago. So I didn't know until not too long ago that we were relying on surveys. And maybe surveys made a lot of sense where you gave people, 1 month, 2 months, 3 months to fill them out and get them back to you. Maybe that used to make sense. But we're in a time where we have data at our fingertips, and it should be much faster than that. So the idea that our monetary policy and the markets in general are completely reliant on survey data with jobs.
And especially now they have to mail them in at 78 cents a shot now.
We don't know if they're mailing it or emailing it or sending it.
I believe they do.
I don't know.
Less surveys, they have a good response rate, so we should have this in mind as well. But of course, you cannot have monthly data again to have to get data from every business. So that's the best way to do it, and that's the reason I think we have the revisions. We take revisions. All government data are revised sometime because again, they're based on models surveys that, from the nature of the data, you cannot collect all this data from I think from across the country. So I understand the revisions, and this is the reason to have revisions.
Yeah, I again,
I don't know the magnitude of the revision.
I don't know all the logistics of how it's done. I feel like in 2025 we could be doing it differently than we did in 2005.
Mm-hmm.
I do.
Because the faster we get the right data, the faster we can make changes to adjust and go in the right direction.
And when I've had this conversation with economists over the years, the contention is it's better to have bad data that's current than to have the right data that's old. And to me, that never made sense. But to every economist I've ever talked to, it makes total sense. So
Yeah.
So we want to hear your opinion.
It's good to have some data than no data.
I always say, but I don't understand why having bullshit data actually is better than having the right data. Because think about this. Think about the impact that that jobs report. Let's just stick with the jobs report. Forget about anything else that might be wrong or right. Let's just stick with jobs. If you get not if, when we get these jobs reports, it moves the markets. So that means that our borrowers' rates go up or down, right? So if our borrowers are now having to pay more in their interest rate for the next 30 years because we had a flawed jobs report, which we now know we've had many, so many. These people are being impacted because we have flawed data and we're reliant on that. And I cannot wrap my brain around how we can have a stock exchange where we have all the dollars and pennies and cents down to the second or millisecond, but we can't get a jobs report. Or here's a better idea. Let's say we can't get better data. Why is it that the Fed, and again, this goes back many years, this is not specific to right now. Why is the Fed looking at the current data? Why aren't they looking at revised numbers and basing their
But
decisions
the
on?
market should be looking at the revised numbers more, but they don't.
And then to the market and as a whole, why on earth do they even pay attention to this? Because again, they also should know that we're having these monster revisions. And when I don't know, I'm very frustrated by this, and I have been for a very long time. As anyone who's listened to this show for, the last 5.5 years, I've been railing on this forever. And it's not getting better. It's just becoming more and more clear that more people are talking about what a big problem.
Yeah.
So I don't know. I mean, do you hear of any ideas around how we can tighten it up, make it better, fix it, get data faster, better?
Have statisticians, and we have, so we trust that. So again, it's like the process. It's difficult to have like, as I mentioned, like within a month to get like real data. So that's the thing. And again, BLS, and that's the reason that we go to the federal like data, and we are based on the federal data because they have very good response rates compared to other like private like sector like data. So still, I will say like for my analysis as well, I'm like federal data remains to be the best source like for that we have out there. And as you mentioned, I know that you and I already said that it's sometimes good to have data and you can revise that than not to have any data and not to have any picture about the economy or about like the jobs. So that this is how I try like to justify and to explain why most economists like they say that.
So I would be okay with the data being revised if it had moved the markets so negatively so that the borrowers' interest rates weren't impacted so dramatically.
Markets are impacted by expectations as well. So for example, now, like with the mortgage rates or the 10-year treasury yields, so this is what we see. They respond to expectations than the real action. So this is what we need to have in mind, the behavioral economics as well on the side that we have to have like in mind that, yeah, that's another reason to keep in mind like how markets like change and are affected.
Yeah,
Yeah, I think we've beaten the dead horse.
no, I don't know. There has to be a better way to do this. There has to be. I cannot imagine that in 2025, with the tools at our disposal, that we cannot come up with accurate numbers faster. But that's just me, and I know less than you. And so, but it's really hard when we're looking at the damage done to our borrowers' finances for now and into the future, when they are having interest rates that are based on data that ends up being very flawed. So I don't know, it's rough. It's rough. For us, like we're dealing with the borrowers, and And then here's the other thing too. So we have these things called EPOs, so early payoffs. So let's say somebody takes a higher rate today
Mhm.
because the expectation is that, these are good rates. And then we find out that the data was wrong and the rates go down. And then they're like, oh, I can refinance and get a better rate in 3 months. Well, guess what? They pay off their loan early and we have to pay everything back, everything that we made on a loan. And so it's like there are so many different layers of this when it hits the ground where it's affecting the consumer and what in our dealings with the consumer. And I think that there is a real disconnect between the market and the consumer and the impact that some of these things have. And so it's just like, oh God, it's really, really hard. Um, so yeah. QCEW, yay. And the other thing
Interesting day today.
I know, well, and then the other thing I think is interesting too is when we think that the numbers should be lower and they come in higher, then we're all upset. But then, and we think that, they're wrong, right? But then when they report that they're lower, we believe that because that's what we want them to be, because that's what we think they should be. And then when you really start to think about connecting the dots, and then you're talking about inflation data, which is produced by the same, BLS.
Mhm.
Okay, is that data right? And again, this is not political because I've been questioning this for a very long time. So this is just a function of how
It's based on your bias, Audrey.
my bias, what the fact that I don't like, these massive revisions that hurt my
Now
clients.
you want increase in jobs and you want decrease in rates. I know how you roll.
Yep.
Those
Yep.
don't work together though.
What?
Those two don't work together.
Know what you're talking about.
When there's more jobs, rates go up, not down.
I know.
Yeah. But you can't have both.
I-
Pick one.
Okay, that is literally not what I'm saying. Okay, so anyway, okay, I cannot believe the number of people who've had Philly fans issues and experiences. So so somebody is asking, and I've asked this question before, and maybe you have an opinion about it. So again, I think we've talked about a little bit that you like to have current data versus old data. Someone said, since they're always adjusting the numbers, would it be better to delay the announcement of the numbers by 60 to 90 days? And and then also when someone retires and someone is hired to replace them, is that a new job? Do you know that?
When you retire and you get a new job,
If someone leaves their position because they retired and then someone else is hired to fill a person, that's not a new job, right? That's just replacing someone in a current job.
it depends if it was like off and then it started again. So I will count it as a new, if it depends on like on the business.
It's a new job for the person in Tucket.
Oh,
It-
for the person, yeah, but for the business, if they stop it having their in the chart, then they will put it again.
Okay. And then the birth death model. That's a whole nother topic. Should we just leave it? I know that you're gonna know how I feel about that. Oh, geez, Louise.
But
Um,
what other stats have we got? So maybe go on to other NAR stats and show us what's going on with the economy here.
Okay, so someone asked me this morning about how long the BLS jobs numbers have been wonky. I said about 20 years based on what you said, Audrey. I'm like, okay, for God's sake, I just know if I think back, I can think of 2000, I mean, the early 2000s and me standing in my office being super mad that the jobs report had been revised down. And I didn't know anything then. I mean, literally, I knew nothing. So this is all very anecdotal and not to be trusted at all. Someone would have to go back. Nadia, maybe you could do this because you're good at data, instead of anecdotal
I
stuff.
love data. Yeah, I love data. And sometimes I'm like, if you think most of like of our members, they don't understand like the census comes like so late, like there's such a big gap, but it's good data then. I'm like, because now we still report the 2023. We don't have anything like for the 2024, and we're like, we passed the half of 2025. If you think about it, so we have a big gap. And fortunately, like the data for 2024 are coming next week as well. Yeah, on the 5th, I think, yes, or this week on the 11th. So we have like, at least we're going to have the American Community Survey like data out there.
Oh, wow. All right.
Yeah.
Well, Something else to look forward to.
Yes.
Um,
You have more about demographics, about buyers. So I'm still looking forward.
oh my gosh.
So
Okay,
many topics.
then we had the Beige Book come out. That is the Fed's report from their 12 districts, and that's them gleaning information from their business contacts in their districts. 11 of 12 of them said that there was no job growth, and one district said there was contraction. So it's a weak report there as well. So it'll be something. So we have the Fed decision on September 17th. So again, we have two more inflation numbers this week before that next meeting. And there is a 100% probability of a decrease of at least 25 basis points baked into the market right now. There is an expectation that will definitely happen. And then people start speculating, well, maybe it's 50, maybe it's 75 basis points. And do you think that would, do you think that's going to happen? And B, do you think it matters at this point, whether it's 50 or 75 from our perspective, as far as mortgage rates go?
So I don't expect 75. I think it's too much, like for after like keeping like holding it at the same like unchanged for so long now. I don't think they're gonna go with 75 basis points, but I will expect like 50 or like 25 basis points, and that's good to have. We have the numbers out there. We see that the labor market is cooling. And that's another indicator that it's safe now to do like the Fed rate cut. However, what I would like to clarify is that the Fed, we should have in mind that the Fed doesn't set like mortgage rates like directly. So what it controls is the federal funds rate. That's the rate that the banks charge its other like overnight. But of course, that benchmark ripples across the entire like financial system. So it has an impact on everything from savings accounts to car loans, for example. And yes, of course, like mortgages, it affects mortgages as well. So, and here's why home buyers and everybody, I think, care about that. So when the Fed has a rate cut, so the long-term bond yields, especially the 10-year treasury, usually fall. And since the 30-year fixed mortgage rate is closely tied to the 10-year treasury yield, mortgage rates often start like declining before the Fed actually makes the move. We have seen that dynamic like play out before, like historically both treasuries and mortgage rates trend down a few months, I will say, like ahead of anticipated like cuts. And we also see it like now. It happened, for example, last year, exactly the same time, like mid of September again. And in prior cycles, I will say, like in 1990, when we had the Fed rate cut back then, or in 2007, and markets move on expectations. So sometimes we don't need the data. It's about like the expectations we have, like consumers have there and investors have there. So not just the decision day itself. So that's exactly what's happening now. So even though the Fed hasn't cut yet, the 10-year treasury, as we mentioned already, has been easing, especially like this week, reaching the lowest. I think that's the lowest level that we have, at 4.1. It's since April of 2025. And mortgage rates have followed, and they're like 6.5% according to Freddie Mac. So that's the lowest we have seen, I think, since last October. So it was like when we had the second like Fed rate cut like last year. So the market has already priced in some of that upcoming rate. And of course, the question always is, so will rates keep falling? So, okay, we see them, they're down. So we have the rate cut. So are they going to continue falling? And I think this time is a little like different than what it was like last year. And here's why it feels like different for last year. Like a year ago, after the cut, mortgage rates briefly dropped, but then bounced like higher again because the economy was still running hot. So jobs were strong and the labor market was powering like demand. So this year, the backdrop is like different. So jobs, as we mentioned, job growth has slowed, unemployment is a little bit like higher, and that labor market is cooling. That labor market cooling is giving the Fed more room, I think, to ease without markets immediately like fearing of a rebound of the inflation, because that's the other like component that we need to think. And that was one of the biggest concerns like from the Fed not cutting like before because they were afraid of inflation like bouncing back and increasing. And speaking of inflation, it's running like about like 2.7 now, so a little like lower than a year ago, but still higher than the Fed's target. In the meantime, we see that, as I mentioned, that there are more unemployed than the job openings. So this means that the labor market is tight. So that's one of the reasons I think this time the rate cut may be like more effective than it was like last year. Sometimes they ask me like how low could mortgage rates fall after the cut? So that's another question I think that many of us have. And this is a very challenging like question. So predicting like mortgage rates is difficult due to the complexity, I will say, the all this interplay like of various economic factors that influence them. However, in a very simple terms, when we take a look at the data, historical data shows that a 100 basis point rate cut typically leads to about like 87 basis points drop in mortgage rates. But with the Fed expected to lower its rate by 50 basis points, for example, by the end of the year, like a little like 75, we have like the two rate cuts, like 25, 50 now and 25 another one, or like 25 and 25 another one. So 50 basis points by the end of the year, mortgage rates could fall to, I will say, about like 6.1%, like 6.2 by year's end, from the 6.5 we have like from Freddie Mac currently. So, however, this impact will likely be less, I would say, as mortgage rates have already priced in. So they priced in some of the expected rate cuts. So that's one of the reasons we have to have in mind that probably it will like it will decline like less than what the data usually tell us, that between the interplay that they have like the Fed rates when they come down and the mortgage rates. So we are currently 6.5, 6.3 gives them the mortgage news daily. So we should have like by years end the next year, this is what we expect is about like 6% like for 2026 mortgage rates to average in 2026.
Okay, so last year leading into September, because this was in my notes, this is something I think we've all been worried about. We were down 5/8 before the Fed meeting, and then they lowered big time. It was stable right after that, but then Nadia, the jobs report hit, and that's where they threw the freaking roof. And as we know now, those were not real numbers. So whether the economy was strong then or not is debatable, in my opinion, because we were not working with the real numbers. However, this year, it's interesting to hear your take on this year, and I hope that is the case, that we have a different situation leading into this jobs report. I think it is, to your point, really important to remember that Fed funds decrease is already priced into the market. So then what happens afterwards is going to be very important. But also these two inflation reports that we're expecting in the next couple of days, those are also going to make a difference. So what are your thoughts on, because are the replacement numbers for last year were really low, right? So are we going to make progress on inflation, or do you think it'll be enough of, if the trajectory remains downward, and because that's what the Fed has indicated every time I've heard Jerome Powell speak, they're saying, listen, as long we're headed towards 2%, we don't expect to get there right now. Expecting out like 2026, maybe even early 2027. I don't remember the latest, but so they seem to be realistic about when we're going to hit that 2%, hopefully. And but then in the meantime, I've heard mutterings about maybe the 2% isn't the right number. I mean, they may change, right?
Yes, and this is what we think. I think that it should be like somewhere like higher a little bit, to tell the truth. So, and they made like the adjustment to have like an average. So before they had like just like a benchmark. Now it's the benchmark is the average. So this means it can be like 1 month like 2.1, the other month like 2.2, but then if it goes 1.9, for example. So what they want to have is the average. But again, I think this is the low as well, like rate for the inflation in the current like standards that we have. But so 2.7, I think that if we have the one rate cut, we need to have another, like a second rate cut, to see like more of a higher impact on the mortgage rates. If there is only just one, we may see a little bit, but then I think the mortgage rates may like bounce back because they already priced in this upcoming rate cut like next week. So if there is if a second rate cut will follow, I think that can also help with the mortgage rates to go closer like to the 6%. And inflation, I think due to slower job growth, this can help with inflation not rising as it was like last year, for example, at the same like period.
So do you think that 2 quarter cuts, one in a row, one after another, would be better than 150% cut?
I think so, yes.
Interesting, really interesting.
And do we?
Or we can have like 50 basis points, but to continue again, to have not 75 that you mentioned like before. So, or we can have the 50 basis points and then a second one to follow. So otherwise they may get the 50 basis points. And if there is no second one and they keep it over there, I think this will slow down like the mortgage, the effect that they will have on the mortgage rates. So that's the reason when investors expect like more cuts, that's good. It's they react to expectations. If they think that, okay, they cut the rates 50 basis points and they don't know for the next meeting if they're gonna cut them, then this can not make like mortgage rates to go like even lower. I think if they get like 25 basis points, they see that they expect like 3 weeks ago, I think they were not expecting, they were not sure about that. Now they're very certain because of the jobs like report that we have out there. So now they get that it's going to be for sure like the 25 basis points. We may have like 50 basis points, but if this will not continue, I think this cannot like not make so effective like the Fed rate cut on the mortgage rates.
So shouldn't the Fed know what a neutral Fed rate is and try to keep it at a neutral versus, because the Fed's either trying to stimulate the economy or slow the economy down or keep it on pace. And let's just say that, a Fed fund rates, what's that right now? What 3.75 right now? Am I wrong on the prime? So let's say 3.75 is neutral. And then if you want to slow the economy down, you would, kick it up a quarter or a half. And if you really want to slow it down, kind of like when Greenspan was, running things in the Fed and he was a over exuberant stock economy, he started cranking the rates way up. Ahead of that.
Yeah, I think the timing as well. I'm like, we are not there yet, the neutral that they can have. That's
so neutral can change, is what you're saying.
Not can change, but now they're still not there yet because, for example, okay, they expect to be by the year end to be closer to 4% or like lower than the 4%.
Mm-hmm.
So since they're not there yet and they have to react in the economy still because of the pandemic. Like before, they were like acting like they were rising. Now they try to lower. So that's the reason they're not there yet for a neutral. So the economy is not at a level that they can be like at the neutral, I will say.
So do we get a dot plot this meeting? We didn't get one last time, right?
Sorry, I think.
Where the dot plot where they're showing, they do a survey of the governor voting members to see where they are as far as cuts.
Yeah, I'm not sure if they had it like.
I don't know. I don't know if anyone else remembers from this last month. So
I thought there was 2 that wanted to cut and the rest held it steady, if I remember right.
well, you're talking about voting, how they voted.
Oh, okay, yeah.
Yeah.
No.
I don't think there was. So we should get one, I think, this meeting, which will be interesting.
I think so.
Shift. I mean, I would imagine there's been a shift. And also there was a question about whether Lisa Cook was going to be there and observing or whether she would be voting. I don't know the answer. We'll see what happens with that. And, are they able to get this new guy in there in time for the vote? He was before the Senate, I think, the other day or somewhere in Congress being interrogated. So anyway, there's a lot of variables at play here that we're not going to really know until it happens. So, but without that being said, I think it's interesting because I know that they're saying that the Freddie rate is 6.5. I just locked people in
6.5.
6 and an 8, no points. 6.125 is what I've been locking. So I'm always
Cool.
curious about the disconnect from what I'm seeing as the average rate and what I am able to do for my clients. And so I'm wondering, maybe they're, I don't know, maybe, yeah, I don't know why they're,
Maybe the company you're locking with is ahead of the curve.
that's hard to imagine, I have to say.
It's good to get like lower rates than the one that
No, it's great to get lower rates. And I have to say that for me, with my clients, what I'm concerned about is people that are closing now. If the rates really do head down, it's important to get 6 payments out of someone so we don't have an EPO. And so I am always thinking ahead to, I want to make sure I'm locking in the lowest rate I can get them right now. So it's going to take longer for them to get something better. Does that make sense? I don't know. What is everyone else doing?
I'm locking as soon as I get a chance. That's just me.
Said September is with dot plot, so that's good. So we'll have some idea. And
5.75.
okay, someone else said that they're getting 5 3/4, but it's
Yeah. Borrow paid. That's
lender paid at 6 and an 8. So it's definitely good out there.
And of course, like lower rates is good, like for the market, like for the housing market, and for you as well. I think for everybody. So recently we computed like how many like more households will be able to afford to buy, like from 7% to 6% rate, and what we see like about like 5.5 million more households will be able to afford to buy with a 6% rate. And in this figure, like in the households are included about 1.6 like million renters, who are the potential like first time buyers. So that's the reason we expect like to have like more home sales like in 2026. And specifically, of course, not all of them, like not all of the 5.5 like million households will buy a home. And what we have found like in another like it's about like 10%, usually 10% of the households purchase like a home. And so this can also mean about like 550,000 like more home sales in the next 12 to 18 months. That can help like with the figure to go well above the 4 million units that we have.
Well, so let's talk about that, Nadia. So Nadia took a vow of posting on LinkedIn every day. Every day. That's a huge commitment, just for the record. So you can follow LinkedIn and see some of her musings. And I picked a few of them that I wanted to talk about. And one of them was the rates matter more than you think. So the fact that when the rate goes from one point to the next point, obviously there are more people who can benefit from that, whether they're able to afford something or they're able to refinance and save money. So it is something, and actually we should all be on super high alert, and we should be spending our days getting our clients ready for when you're going to lock them and how you're going to be able to save the money. So if you haven't done it yet, for God's sake, go take a look back for your clients over the last 2.5 years and get people ready who might benefit from a refinance, or look at your buyers and see who was teetering on the edge of, a DTI issue or affordability issue, and would they benefit with the rates where they are now versus where they were even a few months ago, frankly. So so today, Nadia had posted that the total value of foreign direct investments, FDI, here's a new acronym for all of us who are dying for more acronyms, in the US nearly doubled in a decade. So it went from 2.9 trillion in 2014 to 5.7 trillion in 2024. And so why don't you walk us through, so this is your data now, Nadia. So tell us about what that really means and how it impacts the market.
Indeed. So because there are many questions about if we're still like out there in the global market, if the US is still like the lead, and this is what we see. It's the leader in the foreign direct investments. They get the most of them. So the stock, the total value of these foreign direct investments has grown and has grown like significantly, as you mentioned, like it's almost like has almost like doubled from 10 years ago. And what we see actually in the real estate industry, the real estate industry was able to increase much faster, almost like twice the pace like that the overall like FDIs like had. So what we see is that in 2014, the FDIs in real estate were accounting for 2.3% of the overall FDIs, and now it's like 3.3%. Of course, sometimes this is like many people think it's just like 1 percentage point, but this, when we take a look at the real value there in the money, is about like $120 billion. So that's how like much faster has grown, and the main reasons for that is the price gains that we have. We have a resilient like real estate market, and many investors know about that, and that's the reason we are still like so attractive as a country. Of course, what we see in the new direct investments, so this is the total stock. So the new direct foreign direct investments has slowed down, but that's the global trend as well. So we should have in mind what is going on in the other countries as well. So we see the slowdown, but again, we are still like the leaders. We are the first ones in the foreign direct investments, and that's very good to see and to emphasize there, and for everybody to know, especially like the real estate market, that have they made like all these gains.
So on September 4th, you said, who owns their home free and clear? 41% of US homeowners, 35.5 million people, have no mortgage, which is a great number. And then you went on to point out the places with the most homes owned free and clear and the least homes free and clear. And I thought it was interesting that Washington, D.C. at 30% had the least homes that were owned free and clear. Do you think it's because, why do you think that is? You live there, right? Why is it that less people own their homes outright in DC?
Maybe it depends on how long. So that's another interesting like point to take a look, like the tenure that they have. Usually in DC, they're like younger than other areas. So they don't like the turnover rate is like higher, like here in the DC metro area than in other metro areas. But yes, that was unfortunate to see that. And it's the cost as well. I'm like, it's one of the high cost areas. So they need to have to finance their home purchase in order to make this transition, like from rentership to home ownership. And I think that these are some of the reasons that can explain why, like in DC, we have these, unfortunately, like fewer owners that are free and clear, unfortunately, yeah.
Wow.
But that makes me like very interested, like to have like every day and did you know, or like a marketing side, because I learn as well. I'm like, because it makes me like to look at trends that sometimes they're out there and we don't know. Like we don't know like exactly what areas they are performing better than other ones. And I like when there's this contradiction, like when I compare like the best, and unfortunately some of them they're not, like they're falling behind.
Okay, here was another interesting one, in my opinion. When mortgage rates fall. So at 6.4%, when the average rate is 6.4%, 862,000 more households can afford to buy. At 6.25%, which is not a huge drop, 1.7 million more households can afford to buy. So your point was small shifts, huge impact, which
Yeah.
could not be more true. So again, we need to be looking at our borrowers and making sure that we're paying attention to, hey, they couldn't before, maybe they can now, or they didn't want to before and they can now. You also, okay, another one. More people are looking for open houses this summer compared to last year, but activity is still only half of 2019 levels. So it's increasing. It's going back up. What are your thoughts on that?
It's the interest. This is based on the searches, so the Google Trends. So I took a look like how many they were looking for an open house, and we say that there were like more people looking for an open house. So, and there's more interest in the open house that we had like last year, but still we're falling behind like significantly from pre-pandemic levels.
I have a borrower who has a house for sale or a place for sale. I think they're finally in contract, but they were frustrated because in their area, the realtors do not want to leave their houses and go show houses. They don't want to go to open houses. I'm like, okay, again, we need to get back to what we know works, and you have to actively do something to buy or sell a house. So, good grief. I've heard this stat before, but I thought this was interesting because I don't really understand exactly how it translates. Every home sale creates 2 new jobs. Using that ratio, 1,000 home sales generate 2,000 jobs. And you said in Hawaii and California, the impact is almost double. So when those jobs are created, do they stick? Like those are 2 new jobs, but do they stay forever in the job pool?
That's a great question.
They stay because they want them. It's not only the construction, so it's like the ripple effect. So when there are like more people, like more residents, this also means like more restaurants, more like grocery stores. So that's the ripple effect of having like more residents, like more homes in a specific like location. So yes, they stay, and that's good. That's one of the big impacts like of the real estate market of the house.
So are you saying more homes are built in the area and then therefore sold? Or is it just that when a home sells, more
So
jobs?
when one is sold, then it triggers construction as well, where
Right.
they sell a home. There are studies that we found out that they trigger like construction. So when they come, and then more come over there when there are home sales, usually we have moving like companies, they get like more, of course they need someone like to help them with the move. So again, it's like realtors, there are like as well like moving companies that they need like to help with the move, those ones that they leave, and these ones that they move back. And then the home sale triggers as well, like new homes there as well.
Interesting.
Okay, so this will be the last one, but still very interesting. So home versus yards over time. Homes grew for decades. Now they're getting smaller. Yards shrunk more. So in 1970, the median home size was 1,525 square feet. In 2015, which was the peak, the average or the median home size was 2,467 square feet. In 2024, we're headed back down, and now we're at 2,146 square feet. And then the lot sizes went from almost 14,000 down to 9,439 in 2015. And now they've gotten even smaller at 8,545. So again, more space, smaller yards. Interesting. I just think
I see it next to me. Everyone wants to like to build, but now the good thing is that we have the new homes. The size of the new homes like is smaller, so it's getting like smaller compared to recent years. So that's a good trend to follow, and that's the reason we see like new home sales, like the price of the new homes is like lower than the existing homes, for example. That's one of the reasons of the size.
well, if you like these kind of little tidbits, you can find Nadia on LinkedIn. Kevin, we always talk about how we know that it was a good episode when it goes really fast. This one really fast. And also, we don't even have time to discuss our Treasury Secretary threatening to beat the crap out of our head of FHFA, or the new accusations about mortgage fraud and occupancy fraud.
Yeah. Don't throw stones if you live in a glass house. That's general rule of life.
Amazing. So anyway, Nadia, thank you so, so much for being here today. We really appreciate it. It was great.
Thank you.
And to all of you, there's a lot of business out there. Go get it. Close some loans. We'll see you next week. Bye, guys.